got Dylan on here. We got Michael. All right. Just hit the go live, and then we'll be good to go here. All right, we're going to get going here in just 1 second. Let me know if my screen is coming in a little bit laggy. What's that? I didn't quite catch that. Yes. Oh, let's see. Well, we'll go ahead and get started here. Yeah, I have the calendar pulled up. Alrighty, welcome everyone to today's Sunday macro wrap up for Sunday, February 23rd. We got a lot to cover in this section here today. So, like always, these are every single Sunday at 7 p.m. Eastern Time. The first 30 minutes are streamed live for all of our viewers. And then the second 30 minutes, we're going to close it off and go offline just for the members in our community who are on the call live here to answer any questions about certain positions as well as our process. And so if you'd like access to that, just go to the link in the bio there to learn more about our school community. But getting right into it here, as always, we're going to take a look at things from last week as well as things coming up. Last week, we got some good data for the top two manufacturing surveys, mainly the New York Fed manufacturing survey. So this had a rebound after it was negative last month. And so essentially what we're looking at is a rebound in manufacturing. And so what's interesting is that, even though manufacturing, which has been in a recession over the past couple of years, it's now starting to go into expansionary territory for the first time in a while. So we're seeing that confirmed not only in the New York Manufacturing Index, but also too with the Philly Manufacturing Index. So those are the two large ones, only because they cover the most area, as well as you have a very they're connected to a lot of different. I'm not sure what's happening here. Computer's a little bit slow. I will note that on the Philly Fed, what was interesting was new orders had a decline while prices were accelerating. And so we're going to get into some of the different prices that we're looking at as far as commodities go, because that's the big inflationary tailwind. As of right now, we're seeing a large appreciation in commodity prices. And so that is being translated into manufacturing prices paid. And so, the market is still a little bit cautious in terms of inflation reaccelerating. Although we have it pretty much staying almost in a neutral spot where it's not coming down and it's not really going up very fast. But that could be still problematic. Let me just submit some people here. And so taking a look at the services PMI, so we got the flash manufacturing and services PMI on Friday. And so just like we were talking about, we continue to see services decline. So this is we saw the second consecutive decline on a month over month. And so this was at the lowest level since January of 2023. And the reason why you want to pay attention to services data in terms of the United States is because services is really what makes up the majority of the consumption. It's about 70% of consumption is in services. And so part of the robust economy that we've experienced over the past couple of years has been because of a strong services sector. And so now that we're seeing this have a contraction, while on the other side, manufacturing is accelerating, this is definitely a shift from what we've experienced over the past couple of years. And so if more of the services economy starts to decline, you could really see a decent contraction in growth, which is partly what we've seen so far. And then we also had the University of Michigan Consumer Sentiment Survey, and that had a large drop off as well to levels that haven't seen since December of 2023. So consumer confidence declining with services, that pretty much makes sense. Now taking a look at some of the different publications or the macro data that's coming out this next week coming up. We have consumer confidence on Tuesday. We have the second estimate for Q4 GDP on Thursday, and then we have core PCE on Friday. And so core PCE is the Fed's preferred measure of inflation. And so as of right now, let's see. Yeah, the Cleveland Fed has core PCE coming down to 2.51 and 2.66. Currently, headline PCE is at 2.6, and core PCE is at 2.8. And so they do have a slowdown. If you remember, the Cleveland Fed inflation forecast had a big miss for the CPI numbers a couple weeks ago. And so, this could showcase that if they have a miss here and inflation is accelerating, which is what we're seeing with prices paid as well as commodities, this could continue to have the Fed remain hawkish on their interest rate policy. And so as far as earnings go, NVIDIA reports their earnings on Wednesday. And so that's one of the big ones too, because NVIDIA is one of the most important mega caps. And so all eyes will be on NVIDIA earnings on Wednesday, and we'll do an extensive coverage on that on Wednesday as well in the daily macro update. What was interesting was taking a look at the survey question for, this is for investor sentiment. The big fear was, the economy and inflation, which, usually makes sense, but sometimes it's more so the Fed, sometimes it's just inflation or earnings, but we're seeing both right now. And this is what's causing a large increase in volatility, as well as just general uncertainty in the markets right now. And so we saw a little bit of a translation in the sell-off on Friday, which we'll get into in a second here, but just going over some more growth and data points. So the CRB commodity index, has been continuing to accelerate. And so that's why a lot of the things that we've been long, such as natural gas, which has been the best performer over the past couple of weeks, those things continue to accelerate. There's a lot of reasons for this, as well as some geopolitical, tensions that are going on right now with not only the current administration in the United States, but also abroad. There's partly that reason, as well as that it's wintertime. Usually natural gas has a little bit of appreciation during the wintertime because of demand. But this commodity inflation is definitely real and the biggest threat to the Fed's mandate for cutting rates right now. And so we continue to see for the Q1 2025 GDP nowcast is that it remains pretty low at 2.3%. And so this would be a continued deceleration in growth, which is what we've been forecasting for quite some time. And it's essentially what the Fed needs to happen anyway, because a lot of liquidity is drying up. And we'll get into with the title of this video, which is, the Fed is ending quantitative tightening. What they actually came out with was that they said this plainly in their Fed minutes, which we'll get into in a second. But this is also showing that this year, they're trying to find different ways to maintain liquidity levels where they're at with the RRP completely ran out of money. And so two of the things that I take a look at in terms of the GDP nowcast, you can actually find these updated every single week on Fred. And so what I typically look at is residential investment. as well as business equipment, because those are typically more of the leading side of the indicators for growth. And so, as you can see, the Q1 2025 numbers have been a lot lower than the previous ones. And so that's why we continue to believe that growth is going to slow. And then if you take a look at the target rate probabilities for the Fed, cutting rates on March 19th, they actually have it as a 96.5% chance that they're going to keep interest rates paused where they're at. And I believe they have the first cut now in June, which is interesting because just 2 weeks ago, they had the first cut being in September, but because growth is starting to slow faster and faster, we're seeing that the first cut in 2025 might be a little bit earlier because of growth slowing fears. Because you don't want it to slow too much, but you just want it to normalize so that inflation doesn't reaccelerate. And so that's the big balance with the Fed. Just briefly looking at the 4-week moving average of jobless claims, those continue to decelerate pretty much since August 24th of last year. This has been trending downward, which is a positive note for the labor market. And so if initial claims continue to trend downward, then the market will focus less on the fragility of the labor market and more so towards the growth and inflation fears. And one of the things that I'm looking at here is the 3-month performance of all the different things that we track in terms of prices. And so what's interesting, and I'll blow this up a little bit so you guys can see it better. But what's interesting is when you have, so far in 2025, you have commodities being the best performers, and then the worst performers are more the cyclicals, right? So like materials, energy, retail, things like that. But it is interesting how the growth signals are showing slowing on the actual charts, as well as all the commodity prices are showing accelerations as well. Natural gas and gold, as well as silver, have been the top 3 best performers so far in February of 2025. And so we'll get into the charts here in a second as well. But what I really wanted to highlight was the whole debt ceiling issue that's going on right now that I don't really hear too many people talking about. But this came out on January 29th. Essentially, the United States breached their $36.1 trillion debt ceiling. And so if you guys forgot, the Fiscal Responsibility Act of 2023, which is where they suspended the debt ceiling, and they could just, essentially, it's an unlimited cap on the credit card over at the government. So they essentially enacted that and ironically named it the Fiscal Responsibility Act, but that actually came to a close on January 2nd of this year. And so right now, the Treasury Department, as well as Congress, they're trying to frantically, and this happens almost every single year, they're trying to come up with a way to either have a new debt ceiling or just continue the debt ceiling suspension. And so in order to do that, it usually takes a little while. And so in the meantime, the Treasury Department has to do what's called extraordinary measures. And it's essentially them just making sure that the liquidity dynamics are maintained, but it's only a temporary Band-Aid until they can figure this debt ceiling thing out. And so as of right now, they're just starting to do that over the past month. And the last lever that they have is draining the Treasury general account. And so that's one of the things that we look at in terms of the liquidity dynamics in the markets here. And what I'll do is I'll go ahead and share my screen on the charts here. And so if you take a look at the Treasury general account, you can see that it's currently at $790 billion. And what the Treasury is doing right now is they are enacting the first couple steps of their extraordinary measures, which I do have some notes here if you guys want me to get into the nerdy stuff about it. But essentially, they're just trying to float the market liquidity at this time. And so once we start to see the TGA start to drain, that would mean that, they're getting on the last leg of, Band-Aids that they can put on onto the whole debt ceiling suspension issue that's happening right now. And so, if you guys don't know how all that works, I would highly recommend this article here because this author does a really good job with explaining all this, and I can leave those in the notes below. But essentially, there's a time clock that's on right now to where the Treasury Department needs to figure this out. And I don't think that the market has really priced in the risk of this. They pretty much have full trust in the Fed to do their job and to actually navigate this, but they're basically trying to thread a needle here. And they have to be very delicate. And if they end up misstepping, which unfortunately the Treasury Department as well as the Fed don't have a great track record of threading needles. But if they do end up pulling off, then that's what the market is currently pricing in. And so we really have to be aware that if they do misstep on anything, as they're essentially being very cautious with how they're now issuing debt on the long side of the curve, that whole dynamic is something that is completely different from the past couple of years. And so to really put this on a chart here, this is the Treasury security issuance. And so as we know, the government brings in tax revenue, and then they spend that money in terms of what they spend money on, and whatever they have to borrow from what they don't have from bringing in tax revenue, they have to borrow that from the Fed by issuing Treasury securities, bonds and bills. And so as you can see here, around April of 2023, all of a sudden you had a very large acceleration in issuing Treasury bills, which are like 2-year notes, things like that on the short end of the curve. And so they were able to do this because they had all that liquidity stored up at the RRP in order for the liquidity at the RRP to purchase a lot of those 2-year bills. But now, since the RRP has been drained, now this will start to normalize. So they're not going to be able to issue as many Treasury bills, and they're going to have to bring this more in line with the rate of issuing Treasury bonds. And so this will be a liquidity tightening dynamic, but again, they have to do this very slowly, stair step, and it can't be anything that's super sudden because that will definitely impact the markets in a negative way. And so we actually saw them say this because with this tightening effect happening, they're going to have to stop their quantitative tightening that's going on right now. And so if we took a look at the FOMC minutes that came out last week, they have this paragraph here, which is, I know it's a little bit hard to see, but you'll just have to read this for yourself and take my word for it. But you can see that they say that regarding the potential for significant swings in reserves over the next coming months related to the debt ceiling dynamics, various participants noted that it may be appropriate to consider pausing or slowing balance sheet runoff until the resolution of this event. So just like we were talking about, they're talking about the debt ceiling suspension as well as because of the tightening effect with this dynamic here between issuing Treasury securities, they're going to stop QT effectively. And so the rest of this actually has some really interesting things as well, but this is essentially the big thing that came out. And I really didn't hear too many people talking about this either. But this is something that we were talking about early in the year of things that could happen in 2025 with them pausing QT. And so now they're just announcing it, just now. And so the markets could interpret this as a positive thing because it's loosening liquidity, but it's because tightening is going on in another area. And so just to give you guys a good visual on this, going back to the charts here. So the reverse repo facility, this, which you can think of as an enormous parking lot that's held at the Fed, during COVID, all the excess spending was essentially dumped into this. And so this allowed a huge cushion for the Treasury Department to issue bills at the short end, just like we were talking about. But now that this whole thing is gone, they don't have that option anymore. And so, again, it doesn't mean that liquidity is going to be shortened anytime like soon. But if they don't if they don't shift this issuance from the short end to the long end in a very careful fashion, then that could be a huge drain on liquidity in the markets, which would definitely have a negative impact. And so when you think about different companies in the market in the United States economy that lend lend and buy treasuries, as well as what rates are affected, that's why you've seen the Russell not perform well, because a lot of the small cap companies, they borrow money at the short end, and the large caps, such as Apple, things like that, they borrow at the long end. And so that's why you've seen a lot of those large mega caps actually perform well, even though the Fed, quote unquote, tightened liquidity in the markets. And so, if we take a look at the Russell, it has had a decent rebound since it kind of chopped sideways from May of 2022 to November of 23. But it is still, it's been trending sideways, and it is bearish in our model currently. And so I think right now we have to pay attention to when Congress is able to fix this whole debt ceiling suspension dynamic that's happening. And so right now, I think this was last week, House Republicans unveiled a blueprint to extend the $4.5 trillion in tax cuts and lift the debt ceiling. Now, this is just, they're unveiling their blueprint. It has to go through the process of actually getting passed and enacted. But typically, that doesn't happen until things get really squirrely. And so that's when you start to see it on the news, and you'll start to see headlines of, will the United States government default on its debt, and all those different things. And so we'll probably see more and more of those headlines coming out. But I just think that the market right now is severely underestimating how careful the Fed has to be, as well as the Treasury, working together in order to make sure that liquidity doesn't get drained too quick, too fast, as they transition from this Treasury issuance dynamic that they have to change up from the past couple of years. And so, so far in 2025, the volatility has been a lot higher from the previous couple of years. And so that's been a theme here that we've seen, is just higher trending volatility. And so obviously on Friday's sell-off, there was a large spike in volatility, which is why, our team and I typically like to raise cash when, volatility's, around where it was, around 14 and 15, as well as looking at the VIX over a 3-month VIX ratio. You can see that, it's getting close to that 0.8, ratio mark there, and it had a little bit of a spike. So, in terms of the trend of the S&P 500, it still is maintaining bullish trend. So, there was a lot of people panicking, but, we were raising cash based off of our process. And so, we had a lot of cash in order to buy things that were on sale. And so, but the S&P 500 does remain in bullish trend as of right now, as well as a lot of the different sectors have been performing well. And what's interesting is that when you take a look at the S&P 500 minus the big mega caps, you can see that this has been really the reason why we've been having a decent strength in the S&P 500, because the rest of it, excluding the mega caps, have been having a decent rebound from where it sold off at the beginning of December, or in the month of December. And then if you look at just the mega caps, it looks like a totally different chart. And so even though it remains at elevated levels, it really hasn't moved. It's pretty much been sideways for the past almost 3 months now, the mega caps. And so essentially what that means is everyone who's crowded into the mega caps just haven't been making as much money as they were last year. And so, of course, it's only been the first couple months of 2025, and this could change. But as of right now, it is really interesting seeing a broadening rally happen in the S&P. And so if we start to have a lower high in the S&P 500 minus the mega caps, and this starts to trend down lower, then everything that's being pushed up, if it continues going back down, that's obviously a big headwind in the market. And so we just have to pay attention to this, and that's what my team and I are looking at there. And then, yeah, the best performers, natural gas continues to be among the best performers, not only in commodities, but also just ETFs in general. We continue to remain bullish on gold and silver, um, as well as some international equities that continue to do well. I know that, the DAX has just been ripping, but it's mainly a lot of the other different international equities as well. But it's great to be able to have this macro strategy where, it can just point to different international markets that are performing well, even if, the S&P 500 and the Mag 7 aren't doing well. Because, for example, the DAX, since the beginning of December, while the S&P, while the Mag 7s are pushing sideways for those months, the DAX is up nearly 10% since then. And then there's other ones that are also doing well, such as Poland, as well as Colombia had a decent bump last week. If we go to GXC, or no, that's China. GXG, sorry. Yeah, so Colombia has also been doing pretty well. But it's great to have a macro strategy where it can point to these different assets and not just be, focusing on 7 huge stocks as well as cryptocurrencies. But going into crypto, though, we still have Bitcoin remaining neutral. And so we've been decreasing our exposure. Our model went bullish on Bitcoin back at the beginning of October. And so we've remained bullish as of recently. It went neutral last week, or I think it was 2 weeks ago. But, this is obviously a really interesting price action for what, Bitcoin is doing. It has lost a lot of momentum, as well as the majority of the altcoin space hasn't been performing well and remains bearish there. And so we continue to see Bitcoin dominance in bullish trend, as well as, let me see here, stablecoin dominance is also remaining in bullish trend here. So those are the two things that we continue to monitor in the digital asset space. But there's just a lot better things to own right now than cryptocurrencies. That could change depending on how the liquidity dynamic ends up playing out. But obviously, Bitcoin is pricing in something if it's losing trend and momentum. So that's something to definitely take note of. But yeah, for those who are joining live on our socials here, what we're going to do now is we're going to close it off to just the members who are on this call. And so if you guys would like to learn more about our communities, you can just go to the link in the bio there, and you can start your 7-day free trial of our macro investing community, where we cover a lot of different things in our daily reports, not just the macro headlines as well as the data, but also with actionable ideas as well. So again, if you guys want to start that free trial, it's just a link in the bio there. But we'll go ahead and close it off on the stream and go directly to our group to answer any questions. But I hope you